You can actually pay 0% taxes on the sale of your investments if you know how to do it right. It's not difficult, but you need to know the tricks, and most people don't know how. Today, I'm going to show you how to take advantage of the 0% federal capital gains rate and why you should do it. To avoid the capital gains tax, you need to understand how capital gains work, because if you don't know this, it's incredibly easy to mess up and make mistakes. So let's start here. If you buy a stock, and by the way, capital gains can apply to real estate or many other investments, but I'll show you an example with the stock. Let's say you pay $100 a share for that stock, and let's say you bought 10 shares. So you paid $1,000. That's what we call your cost basis. Well, the stock's done well, and now it's worth $150 a share. So your 10 shares are now worth $1,500. The difference from what you paid for the shares, $1,000, is now worth $1,500. So you gain $500. And if you sell those shares, you create a capital gain that may be taxable. It can also work in the opposite direction, where if that stock goes down in value, you can claim a loss. In this example, that $100 per share went down in value to $75 per share, leaving a loss of $250 when you go to sell the shares. When you have a loss, it can offset other gains. Let's see how this works in an example. Let's say you add up all your gains and losses for a tax year. Your capital losses offset your capital gains, and in this example, you still have a $5,000 net loss. After offsetting gains, then you're allowed to take $3,000 of tax losses per year to further offset your ordinary income. Any excess above that, you can carry forward to future years. When I mention ordinary income, that's the normal money that we're used to paying income tax on that's associated with your tax bracket. That could be income from work or a pension or withdrawal from an IRA. Those tax brackets can range from 10% to 37%. Now that you understand how capital gains work, it's important that you understand that there are different tax brackets for capital gains and ordinary income. Again, it's crucial you know this, because if you don't, you won't know how to take advantage of the 0% capital gains rate. Ordinary income tax rates are what we're most familiar with. When we say I'm in the 22% tax bracket or 37% tax bracket, being in a specific tax bracket means the highest dollar of income you earned is taxed at that specific percentage. But this is a progressive tax schedule. This means each dollar of income from such things as salary or IRA distributions are taxed progressively at these rates. And I'm going to point out the married filing jointly figures for these examples just for your own focus. You can see the brackets if you file single or another method. So up to $23,000, 200 is taxed at 10%. Then every dollar above that is taxed at 12% up until $94,300. Then you can move so on down the list. If you're fortunate enough to earn $750,000, all your income is not taxed at 37%, but just the income above $731,000, 200. Your income is actually taxed at a blended rate according to this schedule. With capital gains, on the other hand, that special income is taxed by different brackets altogether. Nothing like making it more complicated, right? You'll notice that this bracket schedule shows long-term capital gains. That's because short-term capital gains, anything held less than a year, are taxed at ordinary income tax rates, not these reduced rates. Now, many people would know that 15% is the capital gains rate, but that's not entirely true. You'll see here that's because 15% is the largest bracket, from $94,000 to $583,000 if you're married filing joint. But there's also a 20% bracket for really high incomes, and then there's a 0% capital gains tax bracket. Many people do not take advantage of this if their income falls within their bracket. And by the way, if you'd like to get your free retirement assessment, check out the link in the description down below. You enter a few numbers and we send you a customized video with a summary to help you determine if you're on track with retirement. Now let's show how avoiding capital gains and paying at that 0% federal rate works in action for this couple. That at first glance, they'd be paying actually at the 15% capital gains rate. So Mike and Jessica had taxable income of about $100,000, which is their gross income minus itemized deductions. Those deductions can include a combination of state taxes up to $10,000, and that includes your property taxes, mortgage interests, healthcare expenses when you get over certain thresholds, and charitable contributions. The alternative would be the standard deduction, which everyone gets at a minimum, and you simply want to take whichever is higher. But Mike and Jessica, they were itemizing their deductions, and with the strategies we used, it actually saved them capital gains taxes in 3 different ways. What they did was make a $15,000 charitable donation this year that they had planned to give next year, but we accelerated the gift. This increased their deductions by $15,000 and reduced their taxable income to $85,000, and this left them with space to take $9,000 of capital gains at 0% federal taxes before they crossed above that $94,000 limit. So they had this space to take $9,000 of capital gains at 0%, but then the question becomes, well, why realize that $9,000 capital gain at all? Why not just do nothing and still pay no tax? Well, this is like that free spot on the bingo card, because what they can do is realize the $9,000 in capital gains free of federal taxes by selling that appreciated investment, and then reinvest that money using the proceeds from the sale to buy new shares and establish a new higher cost basis. And now they've successfully eliminated that gain. So when they go to sell those shares in the future, they have more cost and less gain, and therefore less tax. And this is known as tax gain harvesting. And if you've done it correctly, can save you thousands in taxes over your lifetime. Future tax savings on that $9,000 of gain at 15% is $1,350. The gain you take may be even larger, or you may do this over a number of years and it can become substantial savings. So this is the first way Mike and Jessica avoided capital gains taxes, and there are 2 more you should know about. But first, you should note just because they paid a 0% rate doesn't mean that's the end of the analysis. There are 3 things you really do need to watch out for. The first is state taxes, which still do apply. Here in California where I live, and also where Mike and Jessica live, capital gains are taxed no differently than ordinary income. So for Mike and Jessica, they would pay 0% federal and 9.3% California instead of that 15% federal and 9.3% in California. Each state has their own tax brackets, and as you can see here, 9 states tax capital gains less than ordinary income tax rates. The second thing to watch for, based on current tax law, is the step up in cost basis when someone passes away. Appreciated shares step up in cost basis to that fair market value of the shares automatically at someone's death, leaving your heirs with no gain if they sell those shares immediately. Now, here's why this is important. I was recently looking over one of my clients' tax returns. She has some room in the 0% capital gains bracket, but she's elderly and not really in good health. Unlike Mike and Jessica, there really was no reason for us to harvest a gain for her. The third thing to be aware of is harvesting capital gains does increase your adjusted gross income, but it does not increase your ordinary income tax rate. Your adjusted gross income is that number that's often used towards qualification of certain things like determining your Medicare IRMA brackets or IRA deductibility. So it's definitely something to watch. But capital gains do not increase your ordinary income tax rate. So Mike and Jessica were able to harvest gains that would increase their cost basis and avoid the capital gain on the increase when they went to sell the new shares later. Okay, here are 2 other ways Mike and Jessica saved on capital gains taxes. If you remember earlier, I told you that they reduced their income by accelerating a charitable donation. The way they made this donation saved them an additional 24% in capital gains taxes, 15% federal and 9% here in California. That's because they donated appreciated stock instead of writing a check. The charity, which is the church in this case, was able to sell the shares tax-free. Had Mike and Jessica sold the shares and then wrote a check, nearly a quarter of that money would have went to capital gains taxes. Also, after donating these appreciated shares, what they actually did was they repurchased the investments from the cash they had set aside in the bank for the donation. This increased that cost basis again on these new shares. By avoiding that $11,000 of gain, this saves them over $1,600 of capital gains. Finally, Mike and Jessica were able to take advantage of that 0% capital gains rate by a third capital gain saving technique that might be hard to spot. In fact, the capital gain savings didn't come from anything specific they did this year. It was actually what we did several years before that put them in a better position this year. Remember that stock example I showed you? Fairly simple. But what if I told you mutual funds actually have 2 kinds of potential capital gains? They have the same capital gain like the stock example. If you bought a share at $10 and sold it at $15, you have a $5 capital gain for every share sold. But the fund also owns stocks or other investments inside it. Those are subject to capital gains also that get passed on to shareholders. And with those, you as the owner of the fund have really no control over these taxable distributions. Often at year end, shareholders may receive a distribution of capital gains, kind of like a dividend, but this is not extra money. It's basically taxable income that's passed along to you. And on a side note, this is why when purchasing a mutual fund in a taxable account, you may want to actually check if a capital gain distribution has been announced for upcoming payment. Because if you buy it right before the distribution of income, this can cause an additional tax for you, even though you didn't benefit from the increase of the fund's holdings. So what's the solution to all this? I remember years ago, around the year 2000, after the tech bubble burst, having a conversation with someone who could not understand, for good reason by the way, how the stock market could be falling apart and yet his mutual funds still distributed capital gains, which was really because the managers of those funds were selling stocks after years of gains. For Mike and Jessica, we put more control into their hands. Years prior, we started moving their mutual funds to exchange traded funds or ETFs. ETFs functionally are a lot like mutual funds in that they are funds that then hold other investments like stocks. The main difference for purposes of what we're talking about here today is the inner workings of ETFs through what they call a creation and redemption process. It allows them to minimize capital gain distributions to shareholders. In other words, ETFs are not forced to distribute nearly as many capital gains as mutual funds. So for Mike and Jessica, there's a good chance they would have had more forced capital gains had they been in more mutual funds and less ETFs. This could have easily increased their taxable income, leaving much of what we talked about today useless. Among the most popular ETFs are those that mimic the S&P 500 stock index. These are often a core part of an investment portfolio, and the index has done amazingly well over the last decade. I suggest watching this video addressing if the S&P 500 is the only investment you need. Alex answers that important question in this video up here, and Alex will see you over there now.